and good morning, everyone. My name is Jillian Bender-Cormier with Bender Insurance Solutions. We want to welcome you to another educational BenderU webinar. Protect the future of your business and drive growth through trade credit insurance. Some housekeeping notes. If you have any questions during the webinar, please feel free to type them into the Q&A section. We'd like this to be an interactive experience, so our presenter will be available to answer your questions in real time throughout the webinar. During our additional Q&A time at the end of the presentation, I'll be sharing other questions you might have with our speaker. We want to be conscious of time, so if we don't get to answer all of your questions, we'll gladly reach out to you individually after the webinar. You are all in listen-only mode and will remain muted throughout today's session. This session is being recorded. At the conclusion of the webinar, the recording link, as well as a copy of the slide deck, will be forwarded to you. We have an incredible expert sharing with us this morning, and to introduce them, I'd like to hand it over to our Vice President of Alternative Risk Markets, Roland Gillen. Welcome, Roland.
Thank you, Jillian, and good morning, everybody. It's my pleasure to welcome Ryan Winkler. Ryan serves as an agent for Northern California for Allianz Trade, where he specializes in helping businesses of all sizes navigate the complexities of trade risk management and credit insurance. Based in Monterey, Ryan partners with businesses across California to safeguard their receivables, mitigate risk, and unlock new growth opportunities. With that, welcome, Ryan.
Thank you, Roland. Thank you, Jillian. I appreciate both of you for having me on this week. I'm excited to present. Just to kind of level set and set an agenda for my presentation today. Going to give you some background on what trade credit insurance is, who we are here at Allianz Trade, how clients of ours use trade credit insurance for various reasons, and then I'll kind of dive deeper into each of those reasons, and we'll open it up for questions at the end if anybody has some questions they'd like to ask. So jumping right into it, trade credit insurance is a fairly unknown kind of niche insurance tool that not a lot of people are aware of, and it's really a two-sided program. So before jumping into that, a couple terms I'm probably going to throw around a couple times today are one, B2B. So we're looking at strictly businesses that sell to other businesses on what we would call open credit terms. So open credit terms, you give your customer 30, 60, even 90 days to pay you back. That's what we're going to call open credit terms today, and we're only talking about businesses that sell to another business. So in this graphic, you'll see trade credit insurance is really a two-sided program. On the surface, or in this graphic on the bottom, it's insurance. We are insuring a company's accounts receivable against non-payment. So when a business extends those open credit terms, those 30, 60 days, and that customer doesn't pay their supplier back, that's where the insurance steps in. We pay you when your customer doesn't pay you. But in turn, because of us looking at your customers, underwriting that risk, insuring those receivables, in turn, we have the largest database of private financial data. So it really is a two-sided program that is insurance on the top, but under the surface, it's much more of an information and database and credit tool. It is for clients to tap into to help them for a various amount of reasons aside from just the insurance. So there's kind of two sides to it, insurance and the information database. So I'll dive deeper into both of those today, but just want to clarify, it's insurance that also has a lot of other benefits to businesses. So you'll hear me talk about information, data. This slide illustrates what I'm talking about. So a couple key points here. We have over 80 million businesses in 160 plus countries in our database that we are monitoring daily with people with boots on the ground. So you'll see in this graphic, we're all over the globe with staff in those countries monitoring the financial health of these businesses. So over 80 million companies that we're actively monitoring, over $1 trillion of trade transactions globally, over 20,000 credit requests a day. So it's a lot of information, it's a lot of data, all compiled into this trade credit insurance package. And standing behind that information is a AA S&P rating. And what that means is not only is there a vast amount of information and data, it's highly reliable. A AA S&P rating is higher than most even financial institutions. So last piece on this slide, we're tracking companies representing over 92% of the global GDP. So we have our eyes on a heck of a lot of transactions between B2B businesses all across the globe. So this is what I'm talking about when I'm referring to the information and to the data. It is all this that we're compiling in one place. First, just going to kind of give you the multiple different reasons people use trade credit insurance, and then I'll dive a little deeper into each of them so we can walk through each reason. First, probably the most simple one is the catastrophic risk protection. That's the insurance piece of this. We are protecting a business from taking unexpected losses in their accounts receivable portfolio, preventing any cash flow disruption from those customers not paying their supplier back. That's the insurance piece of this. Pretty straightforward, but there's a lot of other reasons. First is expanding sales, which may sound a little weird when you think of an insurance product. How am I using an insurance product to expand my sales? But what we'll dive into deeper and what business owners come to find is when you have the insurance guarantee behind your sales, you can more aggressively pursue new customers, new markets, sell new products, because you know you're going to get paid, whether it's from your customer or from us. I spoke about streamlining some credit function briefly earlier. By tapping in to that information in that database, you can really streamline your credit process. As when we meet with clients, Roland and I find a lot customers have a wide array of credit processes, something from very simple that doesn't take them very much time to they have a really sophisticated process that may take them weeks before they extend those open credit terms to customers. So if we can help simplify and streamline that process, that's a really key piece. Next, in some specific scenarios, turning your accounts receivable from an unguaranteed asset to a guaranteed asset, you can access better lending terms with your bank or lender when we're talking about an ABL, factoring, things along those lines. If they're excluding export receivables, concentrations, or other risky customers, putting a trade credit insurance policy in place can help you access more working capital in those specific situations. Last two, export sales. If you're exporting, it's hard to know the rules and regulations of those other countries you're selling into. There's usually more expensive methods, letters of credit, cash against stocks, or just taking that risk on your own. There's obviously a big use case for exporters. And then last, bad debt reserves. A lot of businesses set aside, call it 1% of sales as a bad debt reserve. A trade credit insurance policy is a much more effective use of that money, as usually, let's for example say 1% of sales. Some years it won't even be touched. Some years, maybe that won't be enough. And that bad debt reserve takes profit off the table for your business. And in turn, a trade credit insurance policy is tax deductible, and you get these other positive use cases aside from just carrying a bad debt reserve. So those are the main reasons people use trade credit insurance. Jumping into the first piece, which is the loss protection, there can be a misconception around trade credit insurance. Some people think it's strictly for when businesses filed for bankruptcy. That is covered, yes, bankruptcy, but a majority of claims come from slow payment. So we do cover bankruptcy, Chapter 7, 11, and 13. Your customer files bankruptcy, you file a claim with us. Pretty straightforward process there. But as I said, a majority falls in this slow payment category. I'm sure most business owners and finance professionals are experiencing that today with their customers slow paying their invoices back to you. And that is also covered by trade credit insurance. So it is not just coverage for bankruptcies, but also for slow payment, or what we would call protracted default. So I want to clear that misconception that it's strictly for bankruptcies. There's also the political and export risks. If you're selling internationally, there's a lot more rules and regulations as far as selling into those other countries, and we can help you navigate that and also cover political risks if you're selling internationally and there's an embargo when your product is on a ship being shipped to another country. So this is some good data to look at. This is from the first 6 months of this past year. So it doesn't have the past few months, but it has the first half of the year. And this chart is looking at what they classify as large US companies, which are for the most part public companies, some private ones that have larger balance sheets. There's obviously hundreds, there's obviously thousands of bankruptcies when we're talking about small and medium-sized businesses, but this chart is strictly looking at those larger enterprise companies. And in the first half of the year, over 370 companies have filed bankruptcy, and that's been the most, if you look, since 2010. Obviously, back then, the great financial crisis, we haven't seen bankruptcy numbers at this height since then, as well as there's been a steady increase for the past 4 years. So a lot more pressure on the market, a lot more businesses struggling to pay their suppliers back, and a lot more filing Chapter 7, Chapter 11 bankruptcies, trying to restructure their liabilities and debt they owe to their lender, to their suppliers. So this is an increasing number that we're keeping an eye on, and these numbers have continued to rise, and we're projecting next year for those numbers to still climb. So year over year, we're seeing more bankruptcies, and you really want to take a look at just protecting every asset on your balance sheet, especially as we're moving through these uncertain economic times. I think this is a nice graph and pie chart explaining that. When business owners and finance professionals look at kind of the overall asset portfolio of their business, they have insurance on their land and buildings, on their machinery and equipment, on their inventory and senior executives, but businesses don't look at their accounts receivable that same way. So it's kind of a frame of mind switch of, well, why don't we protect our accounts receivable the same way we do a lot of other assets in our business? And a lot of times the accounts receivable portion of their assets can be anywhere from 40 to, I've even seen up to 80%. So it makes up in most B2B businesses, their largest asset. And when you look at your largest asset and you leave that portion unprotected, it's kind of, like I said, just a frame of mind switch on, okay, I see where you're going with this. We look at other risk mitigation strategies for all these other pieces of our business, but we leave potentially our most important asset just kind of out there without any potential recourse or insurance or protection. So really just a frame of mind switch on, this is our most important asset. Let's keep it protected. A common conversation that Roland and I have with business owners is, oh, I've taken $25,000 or $50,000 of loss over the past year. I've had a few customers not pay us back for varying amounts. And that's just kind of the cost of doing business is, yeah, some of our customers don't pay us back every time. And oh, we write it off. It's just part of doing business. And this is a chart that I go to. So a $50,000 loss to some people may sound like a lot, and to some business owners doesn't feel like a big loss and is just part of selling to other businesses on open credit terms. But when you look at the math here, that a $50,000 loss, a customer or a few customers over the past month don't pay their invoices back to you, and you have to write off $50,000 of debt. Even if your profit margins are at 10%, you have to go and find an additional $500,000 of revenue to recoup that $50,000 loss. So it's a big number to make up for that $50,000 loss. Are you going to find new customers? Are you going to sell more to current customers to try to make up that gap? Or are you just going to write off that loss and maybe the business doesn't make as much profit this year? And on the flip side, if you are more aggressive with new customers, with current customers, you're taking more risk there as well. So what I propose is, what if you don't have to go through that? A policy that either is going to pay you out on a claim, or because of the information that we have, we can give you that heads up of, hey, this customer is struggling to pay their suppliers back. They're heavily leveraged with their lender. They have multiple bad credit references. We take all that data and we're able to give you a heads up, and or we're paying you a claim. So it's once again kind of a frame of mind switch on, it doesn't have to be the cost of doing business. You can avoid taking these small losses. And of course, as we move further to the right on this chart, significant 6-figure or even 7-figure losses are extremely difficult to absorb for most businesses. I mean, if you look to the far right, depending on the profit margins, a lot of revenue has to be recouped to make up for those losses. So if our trade credit insurance program can put a stop to this, then that's our goal, is protect you from having big cash flow disruptions that force your business to go find more revenue in areas that maybe are slightly more risky.
Hey, Ryan, we have a question that's come in.
Sure.
I've worked with my customers for years and I have great relationships with them, and they've always paid me on time. What's the reason to insure them?
Sure, great question. I think that's probably one of the most common questions we get. The two things I would say is, I would just pose how do you know your customers are in a great financial position aside from your payment history with them? Do you have their private financial information? Are you pulling mercantile reports? You can't get access to the lending and banking data that we're able to get access to. If you had all that information, one, maybe I could confirm all your customers are very financially strong, and maybe this program isn't the best fit for you. But I would just ask, what parameters are you judging them by that you know they're in a financially strong place? And at the minimum, I can confirm all your customers are really strong. But from my experience, there's usually going to be some in there that are potentially surprising. And if I can help provide some information and data to open your eyes on, oh, they have slow paid us over the past few months, or, oh, wow, I didn't know they hadn't paid one or two of their other suppliers back. So it's really all about the information. If I can give you the information to at least have the knowledge to extend these open credit terms to your customer, whether they're financially strong or risky, at least you're in the know and have the most active information, so you're not just kind of flying blind.
Thank you so much.
Yep. So moving on to kind of the next category, and the next pillar is the one that I said it's kind of confusing to people to think of a trade credit insurance policy, an insurance policy in general, that's able to help you expand your business, to sell more. It's almost like, how is that? That doesn't really make sense. And it's because in situations where Roland and I meet with businesses, is more often than not, we hear a story of a new customer comes to us, asks us for, in this example, $200,000 of open credit terms to pay you back in, let's call it 30 days. You've never done business with this customer before. You don't know anybody at the business. Maybe it's in a new geographical area that you're trying to expand in. And you tell them, you know, we'll start you at $100,000 of open credit, and maybe 6 months, 8 months, a year from now, once we have some more history with you, then maybe we'll extend that $200,000 of open credit. So in that situation, that business is potentially leaving an additional $100,000 of additional sales because they aren't comfortable with that customer, which I totally understand. But if you had a trade credit insurance policy that you could enter this customer into, request the $200,000 of credit, it taps into our database, and maybe we have private financials, maybe we have other policyholders that work with this customer, and we can approve the $200,000 of credit. So we free you up to sell $200,000 on open credit terms to this new customer, because we're kind of putting our money where our mouth is, in that if this customer doesn't pay you back, we pay you. So this is a decision that's backed by a financial guarantee. So if we approve that $200,000 of credit, just for easy math, let's say your gross profit is 10%. If you sell on open credit terms and give them net 30, just on a conservative basis, let's say you turn that accounts receivable, or you sell to them across a year 8 times, that increases the revenue that you sold to that customer by $800,000. And in turn, the gross profit, you made an additional 80K on this customer. Now, this is just an example, and these numbers can obviously fluctuate up and down depending on the amount of customers you sell to, your average credit limit size. But this is really the main goal I'm trying to get to with clients we meet with, if I can help you find one, two, a handful of these customers that you're potentially restricting because you don't have enough information that makes you feel comfortable to extend that full amount of credit, with our insurance backing, you can be more aggressive and you can extend more credit to new customers because you have that financial guarantee. And if I can help you find a few of these customers, the policy really becomes a sales tool and you get a return on investment from this trade credit insurance policy. So that's really the main goal, is let's find some of these customers that you may not be comfortable extending 100,000, 200,000, whatever that dollar amount is, and let's get that approved and help you sell more. That's my main goal here, is let's find more customers you can sell to more aggressively. So we've compiled all this information that I've spoke about today, and we've put it into a very simple, easy to understand risk grade scale. So you'll see this scale 1 through 10. 1 is the best. Think of Amazon. 10 is the worst. Someone just filed bankruptcy, Party City or Bed Bath & Beyond. Those are obviously at the extreme sides of the scale. And then there's everything in between. Behind these risk grades are about 26 different financial data points. So while it is a very digestible number to understand, there's a lot of information that is going behind these numbers. As I stated earlier, if we have private financial information, we're compiling multiple different mercantile reports. We have private credit history. We have access to the SBFE, which stands for the Small Business Financial Exchange. We get insight into how much they're using their credit lines and credit cards and how leveraged are they. Information that you can't find anywhere and don't have access to, we have access to. So there's a lot of information behind these numbers, but we want to make it simple for our clients to understand and follow. Now, where our product is best fit is kind of through that 4 through 8 range. You'll see the 9 and 10 are obviously bankrupt and uninsurable. Most private businesses in the US or globally fall within that 4 through 8 range. 1 through 3s, while there maybe are a few private companies up there, those are majority public companies. And that's because there's quarterly financials that are disclosed that we can access and monitor the financial health of those companies. So it's really just a matter of access to financial data, and they have the most. So 1 through 3, mostly private companies. Where we really fit well as far as helping businesses navigate who their financially strong customers are and who their potentially weak financial companies customers are kind of in that 4 through 8 range. 4 being really strong for a private company, 8 being highly risky. There's a lot of variance in here, and we have to help you navigate that difficult kind of process of approving credit for these customers that maybe there's not a lot of information out there on them. The mercantile reports are outdated. All these different factors that a CFO, a business owner, a controller has to make a decision on. Hey, this customer, there's not a lot of information on. Maybe there's a late payment reported on a mercantile report. Do we want to extend open credit to this customer? And you kind of have to take that leap of faith. We take that off your plate. You get to tap into our information see if we'll approve that customer for whatever amount of credit they're looking for, and be backed by that financial guarantee. So just to recap, super simple 1 through 10, but there's a lot of that data that I've spoke about today that goes into these numbers. Aside from the sales expansion slide, this is the next important slide to me. I spoke about it earlier, but when Roland and I meet with clients, we hear a wide array of different credit processes that businesses have. Some get a credit report filled in. They want banking references. They want trade references. They're going to reach out to those trade references and want to talk to every single one of them. They're going to pull mercantile reports. It has to go up multiple levels sometimes, all the way up to the CFO. There's multiple people involved, and it just takes a lot of time. And you still, at the end of the day, lay all this information out on the table, whatever your process may be, and a decision has to be made on, are we extending open credit terms to this customer or not? And that can take businesses a lot of time, lose them money, or potentially extend credit to a financially risky customer. So behind the sales expansion, if we can act as an extension of your credit and finance team, this is a tool for CFOs, controllers, credit managers to streamline the credit process that you currently have today. So a key piece of this is we are not only looking at your customers right up front when you enter them into our system or when they're a new customer to you. Once they are in our system, we are actually monitoring your customers on an ongoing basis, because the financial health of your customer today won't be the same as it is 6, 12 months from now, whether it's improved or it's declined. And most businesses we meet with aren't actively monitoring their customers on an ongoing basis. Maybe they have a process up front, but they don't have a process to monitor those customers. We act as both. As I mentioned, over 80 million companies in our database. If it's a registered business, it is in our system. And we have information on them that we can get access to. Whereas mercantile reports, which have their value, a lot of times, especially in the small business space, may not have information, not a lot of information, or very outdated information. And these last two pieces that I think are awesome for our clients once they get used to using the system is it's really fast. Our goal is to streamline your process, make it faster, make it quicker, make it more efficient. If it's not immediate, which a lot of times it is, you enter a customer into our portal asking for $200,000 of credit, you could refresh your screen and have an automatic approval. You're good to go. Ship product out to your customer. It's fully insured. On the top end, we're talking about 24 to 48 hours. If we have to have a risk underwriter do a little bit more digging and some more research on a specific customer, we're talking about 1 to 2 business days. Very quick. Even for most businesses, it takes longer in their current process than 1 to 2 days. So that's my second goal. Let's help you sell more to customers, and let's take some of these time-consuming tasks off your team's plate and make the process as simple as possible.
Hey, Ryan, I have a question that's come in.
Sure.
Can I add a link to our website to facilitate the credit application process for our customers?
Sure. Yeah. We are one of the few trade credit insurance providers. We've been at the forefront of trying to even streamline your application process even further. We have tools that allow you to create a digital application that can be tied back to not only our system, your system, tie those things together and streamline your process even quicker. I would say if you have a large amount of customers in your accounts receivable portfolio, 100, 200, 500, if we can help digitize and streamline that even further, that is a conversation that we can have to have something on your website or a link that you send out to your customers.
Perfect. Thank you so much.
This is the working capital piece that I spoke about earlier. This is in specific scenarios, but can be highly beneficial for businesses trying to grow, or especially today, get access to more working capital, which is becoming more and more difficult and tighter. So in this situation, it's a $40 million company. You see their average amounts that are on their accounts receivable aging report at any given time. And let's say they have an ABL in place, an asset-based loan, and they are using their accounts receivable as collateral with their bank or their lender that they're advancing them funds on. So you'll see an advance rate. What that is a percentage that they are lending to the business based on this average AR amount. In this example, their lender has a 75% advance rate on the 2.5 million of accounts receivable. So that would come out to almost 1.9 million. And in this situation, this business sells to some export customers, and their bank has completely excluded that, which is a very common situation. If you sell to international customers, your bank will exclude that from your borrowing base. They will not include international customers. However, if you introduce a trade credit insurance policy that does guarantee those sales to not only your domestic customers, but to your international customers as well, we can have a conversation with your bank or lender to include that in your borrowing base. So you'll see on this right side, there are now advance rates that have been bumped up on domestic because they feel more comfortable that we're guaranteeing those sales as well, but also the export business can be included as well. So for a $40 million company, they're getting access to almost an additional $1 million of working capital for a policy that would cost a very small fraction of that. So for a small investment in a trade credit insurance policy, in some situations, we can help businesses get access to hundreds of thousands or almost millions of dollars of working capital if we can turn your accounts receivable portfolio from an unsecured asset to a guaranteed insured asset. Then your bank is going to look on your collateral in a much more favorable eye. So in specific situations, that's a conversation we can have with your bank and lender and try to get businesses access to more working capital, especially in today's tough market to get access to. Last few slides, just kind of want to leave the group with some recent examples and some recent statistics. One of the most common responses we get is we had a question earlier on, my customers have always paid me back and I have a good relationship with them, or these are public companies, these are large companies that have been around for a long time. Why would I be concerned with them? And while some people in this call may not be selling to these specific companies, this is just a story of even large, public, really strong businesses at one point can head towards bankruptcy. Del Monte Foods, recent bankruptcy. You'll see liabilities in the billions with 10 to 25,000 creditors. Creditors are suppliers that they owe money to. Claire's, which has been around for an extremely long time. 23andMe, maybe a little newer, also filing bankruptcy. So I would revert back to what I said earlier in how do you know your customers are in a strong financial position aside from the payment history you have with them, because we are looking forward 6 to 12 months. We are trying to look forward at the likelihood your customers are able to fulfill their invoices that they owe to you over the next 6 to 12 months. We're not looking in the rear view mirror. And there's some misconceptions that selling to public or larger companies is really secure and safe in some situations, no doubt. In other situations, we should look closer at some of these customers that potentially are really struggling with their cash flow. Last bit is off the back of that last slide, but this contains a lot of our data on total claims, export claims, domestic claims. You'll see we have a lot more claims domestically than export. So this is not just a tool for export customers. And you'll see these numbers have continually kind of kept ratcheting up. You saw there was a slight downturn post-COVID, but that number has continued to rise. We are seeing more claims, more past due reports, more insolvencies, more well-known brands across multiple industries, whether it's retail like Bed Bath & Beyond and Party City, grocers, vitamin companies, all these different sectors and industries are all seeing difficulties across the map. So you really want to take just a sound risk mitigation approach and at least take a closer look at your customers as they're a part of your largest asset of your business. So that's where I would leave it. It doesn't hurt to take a look and do some more risk analysis on your customers and see where they're at. So that is all that I have today.
Amazing job. Thank you, Ryan. So for our friends joining us, please go ahead and send in your questions. I do have some to ask you, Ryan. It's a pretty simple one. How much does it cost?
Sure. Most people haven't explored trade credit insurance before and don't know how much it costs or how we come to our insurance premium price. The simplest way to understand it is we multiply a premium rate factor times your amount of revenue. So your sales, your revenue, how much you sell to other customers, and we multiply that by our premium rate factor, which for a simple place to start, let's just say 20 basis points is a good starting ground, and that comes from 0.2%. So I'm not talking about 2 or 20%. I'm talking about 0.2%. So for a $10 million revenue company, that would be 20,000, let's say. Now that number fluctuates. That number is influenced by, like I said, the amount of revenue. It's going to depend on your specific industry and the risk we're seeing in that industry, which countries you sell into, your specific customers and the risk profile. So all of those things put together, that 20 basis points could go up. It could also come down. So that's just a starting point, but that's how our premiums are calculated.
Wonderful, thank you. Another question, have you seen companies in the construction industry tapping into this?
Um, Definitely, but it depends on where they fall in the supply chain. Construction has constructed very different risk mitigation processes for how payments are set up, whether it's surety bonds, um, other escrow accounts. So it definitely can be utilized in the construction industry, but uh, it has to be structured as selling from one business to another, and you're extending open credit terms 30, 60, 90 days selling to them, which today not all construction companies are set up in doing it that way. They've put different payment processes in place. So not always the best fit, but there's definitely a conversation to be had there.
Wonderful. Um, what is the application process and process of obtaining a quote for my business?
Sure. It's a fairly straightforward process. We would get together and have a conversation and fill out an application that is mostly just general business information, addresses, revenue targets, losses, in your specific customers. We would put that through an application, and from there, we would be able to get a quote in front of you. So just some general business information is needed, and we're able to put together some solutions for you to evaluate.
Okay, perfect. And just a couple last questions. I have a credit team, a CFO, controller, credit manager, and an accounts receivable manager that take care of all of this. Why would I outsource this and incur an additional cost?
Sure. Yeah, totally get that. And that's a great question. What I would say is we are not replacing those people. We are not changing anything about their job. We are simply giving them better tools to do their job. I would say talk to those people, talk to your team. Are there any points that they're getting hung up? Is it taking too long? Are they struggling to get references? Are you more conservative in the credit you've extended to your new customers? Have you taken a lot of losses recently or in the past few years? Those would be the questions I would ask. And as I said, we're just trying to give them the best tool to make their job as seamless as possible. We're not replacing them in any form or facet.
Wonderful. And if there aren't any other questions, I just have one more. Can a small business use trade credit insurance?
Sure. That's also a slight misconception. Trade credit insurance isn't only for larger, higher revenue companies. Smaller businesses can leverage trade credit insurance as well. We act as an extension of your team, as I've talked about, as well as a smaller business. Maybe it's more risky to extend large amounts of credit to your customers because you can't absorb a single loss like maybe a slightly larger company is able to. So smaller businesses are definitely able to still use trade credit insurance, maybe just in a different way than a larger company would.
Perfect. And I actually do have one follow-up question to the construction question.
Sure.
Going back to the construction industry, do you see it as a better fit for private works or public works?
I mean, it really, every situation is different. We're looking at each individual company. We're looking at each specific one. We insure government, we insure city entities. So it really just depends on each individual company. It's really a case by case basis. There's not really a one size fits all trade credit insurance policy. They're highly customizable. And like I said, we're looking at each individual company in evaluating each of your customers individually. So it's hard to say. It would depend, which I know isn't the perfect answer, but it depends on on what the project looks like, how the payment structures are set up, and who those customers that are paying for it are. And we would take it and run from there.
That makes a lot of sense. Well, thank you so much, Ryan. I think that's all that we have for questions. If you wouldn't mind going just to that next slide for me, I wanted to share what is up next for BenderU. In October, on October 16th, we're going to be having Cyber Fraud and You. We will be having a presenter from the FBI talking with us about some really kind of the latest and not so greatest when it comes to cyber fraud. So please join us for that. To go ahead and get registered, you can just scan this QR code, and we will also be sharing the link to register as a follow-up after the webinar. But just thank you again, Ryan, for sharing with us today. We appreciate you all for taking time out of your busy schedules to join us for today's BenderU. As a reminder, we did record today's session, and both the recording link and a copy of today's slide deck will be emailed to you following the webinar. Should you have any questions, additional questions that arise later on, please feel free to reach out to us and we will be happy to help you. Thank you again, and we hope you have a wonderful day. Thanks again, Ryan.
Thank you.